we are seeing a higher level of bullishness in the market. The pain level has built up to the point where it will keep inflation down. What we are feeling right now is not the impact. The last 6 months have been the fastest rate of change. What the fuck is wrong with you?
Neal, I appreciate you jumping on today again. I've had you on before, and I would like to extend, the gratitude and say that I know you're a busy guy, so just want to say thank you so much for taking out the time today to chat with us again, to go kind of in depth on, the current market trends and, what you're seeing today versus when you were on before last year.
Yeah, a lot has changed, right? I mean, in my mind, at least from my perspective, the last 6 months have been the fastest rate of change in my portion of the real estate industry that I've had to deal with. Not counting the first 2 months of COVID, which were kind of really crazy, but after that actually was a lot better. But the last 6 months have been an extreme rate of change.
Yeah, very extreme. Obviously, with the feds, really doing a lot of manipulation to try to tamper some inflation, and I know we'll go into that. Since you were on last, which was the fall last year, what are you kind of seeing these days versus then? And I know I've not only on my podcast but heard you on a couple other ones where you were thinking, today, early 2023 and into spring and summer months, it was going to be a little bit better for everybody in the multifamily space. What do you see now?
So I want to modify that statement a little bit, Peter. I think that in general, I would say Q3 or Q4 of this year is going to be better for multifamily than Q1 and Q2 will be. But that's not a universal statement. I would say that roughly 10% of the properties that have been purchased in the last 18 months, or maybe even 24 months, are going to face an increasingly worse time as this year goes on. So each month that goes on, that 10% of properties, remember only the ones purchased in the last couple of years, will get worse and worse, will get closer to default, will get closer to cash calls. And that is just simply inevitable. I just feel that while there's more bullishness in the industry today here at the end of January than there was a month ago or 2 months ago, because we are seeing some distinct signs of reduction in inflation. We're seeing some distinct signs that today, a few hours after this podcast is being recorded, the Federal Reserve will meet to discuss their interest rate hike, and there's a good chance that they'll hike by 25 basis points. And if they do, then they're sending a very clear sign to the marketplace that, in fact, they may be, either done or close to being done with their hike. So on the good side, we are seeing a higher level of bullishness in the market. On the bad side, the market is now finally beginning to understand that just because the Fed stops hiking doesn't mean that the pain goes away. In fact, some parts of the pain typically come after the Fed stops, because the Fed now believes that the pain level has built up to the point where it will keep inflation down. So in the Fed's mind, the pain level was not that high a month ago, not that high 2 months ago, not that high 3 months ago, but now they're saying it's built up to the point where it's painful enough for the inflation to reduce, for unemployment to increase, which means that you've got more pain in front of you than behind you, because if that, there was more pain behind you, then the Fed would have stopped earlier. So I think that there's beginning to be an understanding of how real estate cycles work. Also, there's beginning to be an understanding of how the Fed fund rates work. When the Fed increases interest rates, the actual impact of the increased interest rate is not felt for 6 to 9 months. What we are feeling right now is not the impact. What we're feeling right now is the anticipated impact, the bullish to bearishness of the stock market, the crypto market, the real estate market. That's what we're feeling right now. The economic impact of rate cuts typically take a minimum of 6 months and quite often 9 months to be felt. Because if someone already had a property that was in contract, that was locked in, somebody was already at the point where they'd already put down a deposit. Well, those properties, somehow people will, close those properties.
Mm-hmm.
It's the next property that goes into contract after that that will feel the impact from a pricing perspective, will feel the impact from a rate perspective. And so everything is delayed. And the Fed has moved so quickly, so incredibly quickly. I mean, really from May to January, right? Or May to December. We don't know what the January rate cut is. Today's Feb 1st. So we'll know today. They've moved so fast that the vast majority of the impact has not happened yet. And we'll talk about why, I feel Q3 will be good for multifamily, because so far what I'm talking about is not a positive impact, it's a negative impact. And we will feel those impacts more as time goes on, right? So I think that the Fed simply stopping or pausing is not a magic bullet.
Mm-hmm.
It's good for many things, and I'll explain why it's good for interest rates in particular. But it's not good for the pain level. So the pain level doesn't go down because the Fed stops. The pain level actually is at its maximum when the Fed stops until the time that they start cutting rates, which usually happens 6 to 9 months after they stop. There's a plateau at the top. In the past, the plateaus have been as short as 3 months and as long as 9.
Yeah. Yeah, all valid points. I mean, I've seen, a lot of changes like you have over the course of, the last almost year since they started ticking up. What do you see on rent increases now versus kind of like what was trending? Have they leveled off? Do you foresee and forecast in the next year and a half that they're going to stay the same and slowly tick up 2 to 5%? What's that kind of look like for evaluation?
So I'm a little more bullish on rents than the last time we met, and I'll tell you why. The last time we met, I was still looking at sort of a not a worst case, but a worst case for the economy, and that didn't happen over the last couple of months. So the economy has stayed pretty strong, even though inflation has declined a fair bit. So now I'm kind of looking at the middle case for rents.
Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
So now I'm kind of looking at the middle case for rents. I think rents will grow this year by between 2 and 4%. The markets that were the most aggressive in terms of growth, and I'll just name a few, but there's a bunch, right? So Phoenix, Austin, San Jose, maybe Tampa, Orlando, Miami, some of the superstar markets that were growing extremely fast, both in single family prices and multifamily rents. Those are probably going to be at the bottom end of that, 4%, so maybe 2% rent growth for 2023. And then the US as a whole, I think is going to come in close to 4% rent growth. Now, there's a lot of people listening right now. They're like, no, he's just drinking the Kool-Aid. How can there be 4% rent growth when you've got so many problems? People are going to get laid off. He's saying unemployment's going to go up. How does that correlate with a 4% rent growth? The answer is 4% rent growth is actually minus 2% rent growth. So let me explain what that statement means, but I'll repeat it once more. 4% rent growth is minus 2% rent growth because historically, if you look at the 70s and 80s, all periods of high inflation, rent growth was always above inflation. So if inflation was 7, rent growth would be 8. If inflation was 10, rent growth would be 11. So the data suggests that rent growth actually tends to stay above inflation during periods of high inflation because rent growth is, or rents are extremely inflexible. The demand is very inflexible. Sure, it goes down by 1% here or there. So we go from 95% occupancy to 94 or not up to 96, but it's really inflexible within those bounds. And so inflexible things tend to do better than inflation. Things that people can remove from their lifestyle, like stop going to an expensive gym and go to the 24-hour fitness, those tend to actually come down a lot more during a recession, right? Okay. But inflexible things tend to not come down as much. So the history shows us that during periods of high inflation, rents are higher than inflation. What I'm actually projecting is that rents are lower than inflation. So nominal rents will be up 4% in the US, with maybe 2% in superstar markets. But because inflation's at somewhere around 6%, rents are actually minus 2%, right? You take 6% of inflation and you subtract, 4%, and basically you're at negative 2%, right? Because 4 minus 6 is actually negative 2%. So from a inflation adjusted basis, I expect rents to be negative for the United States for this year.
Gotcha. Okay. Yeah. I mean, a lot of the data that I've been reading and how it seems is initially, right, inflationary market, keep going, don't really know what the Feds were going to do. And then, rents were going to go up, in my market, $200 to $400 over the course of the next 2 to 4 years. In some other markets around me, it was at least 100 to 200. So
in terms of increases or decreases?
Increase. This was before, we had the Feds coming in. But now a lot of the trends, just like you said, it's going to level off, and it may even be negative where, you'll have someone before they'll list a property, they'll list, small multifamily, and they'll have something where it increases when they have it listed, $50 a month, $100 a month, because multiple people apply. Now they list higher and they'll reduce it, just like a sale. So evaluation wise on properties, are you guys, for that, that commentary on rents and everything else and on negativity, how are you guys adjusting your numbers? And are you guys pencils down, or are you guys going to start penciling some stuff out?
So we were penciled down until the end of January because, here's our premise, and this is just a premise, right? I don't think that there's anything magical about what I'm going to say. I'll give you my premise first and then explain why I'm pencils up as of today, right? So pencils down yesterday, pencils up today, Feb 1st. And here's my reason. So what most people believe is that interest rates, especially bridge interest rates or floating interest rates, let's just call them floating interest rates. I don't want to use the word bridge. Floating interest rates will only go down when the Fed cuts rates. That's actually usually true. Right now, it's completely untrue. And the reason for that is that rates today are composed of two pieces. There's the SOFR, SOFR, which tends to track very closely with the Fed funds rate. So that the Fed funds rate is in the 4s, SOFR will often be in the 4s, right? Or maybe a little higher. But that's only half the interest rates right now, because on top of that, there's what is known as the spread. That's basically what the banks put in. The spread in normal times is 1%, sometimes even 0%, and then 1.5%, 2%. Right now it's 3. Right now it's 4. There's people actually quoting SOFR plus 4 right now for multifamily loans. And so this spread is extraordinarily wide. It definitely doesn't need to be this wide because lenders are afraid, because they don't know where the Fed is going to stop. They don't know where that top is. Maybe that top is 1 more hike. Maybe it's 4 more hikes. So far, the Fed has hiked more than most people thought they would, right? So now lenders are afraid. Maybe they're going to keep going until 6. There's one Fed governor that said we might need to go to 6. And so everyone's like, let's just take that guy. He's the most bearish and assume that. And we're going to create these spreads, these risk spreads on top of the SOFR. Now, once the Fed pauses, and they could pause, after today, Feb 1st, so the next time they have a meeting is March, then they have a meeting in May. So we'll get a sense either in March or in May where we stand. Then at that point, people are like, oh, maybe they're not going to go up to 6%. Maybe that Fed governor, he was just he was very bearish, and now they're going to stop. Now, the moment that happens, then that spread comes down. And that spread often drops I would expect it to drop by 2%. So without a decrease in the Fed funds rate, you are going to see a decrease in your spread. And the spread matters the most because on a floating rate, SOFR is going to decline whenever the Fed starts cutting. Let's say they cut next year. You're going to get that benefit anyway because your SOFR is going to come down, so your interest rate is going to come down. But the spread is locked in. On the day that you bought the loan and you lock it in, that spread is going to be there forever.
Yeah.
Until you get rid of this loan. So no one should really be worried about SOFR because I think SOFR is artificially high. The Fed will concur with me on that. And it will drop back at some point over the next year or over the next 2 years. So that component of your loan is actually not the one you should worry about. It's the spread because the spread's going to get locked in. So now our premise is this. Either in March, not today, in Feb, they'll if they raise by 25 basis points, they're sort of giving you a sense that they're going to stop. Mm-hmm. So I'm hoping for 25 basis points, but in March, they're either going to say, we'll do a final 25 basis points and then stop. Or in March, they'll just say, we'll stop, right? Or maybe they do that in May, right? So one of these two meetings, I have a sense that the market will get a pause. The market will know where they are. Okay. And then I expect that by July or August, the spreads are going to collapse. And then, so I want to have a property that is not in contract until June, because I want to get the price benefits that I'm getting right now from the extremely high spreads. Mm-hmm. And I want that price benefit when I put the property in contract, but then I want to drag that property out as much as I can so that the risk premiums drop. And the day that I lock in, I have a low risk premium in October.
Yep.
So okay. Pencils up Feb 1st.
Okay. All right. And thanks for the detailed explanation on that, because, some people, they just get into it the first time and they don't know, when to be penciling out deals or, what to be looking for. So with you having a great amount of experience, what for buying properties, are you still buying in the same markets that you had mentioned before? I think we talked a little bit about, it was in Texas. You guys were looking a little bit outside of Austin, I believe.
Yeah. We bought a property in Killeen. We're very happy with how the property has performed. So Killeen's kind of a northern market. Austin home prices have gone up the most in the U.S. Yeah. Even though they're down 10%, they're still the highest in the U.S. After that 10% decline from June, I'm expecting Austin will decline 20%. So it'll go down another 10%. But sure. When it does that, it'll still be 57% higher than 2020. Mm-hmm. Well, so on average, you would need almost double the salary to buy a home compared to what you did before, because interest rates are also high, so that increases your mortgage payment. And so a huge number of people in Austin that would have purchased single-family homes can't. So I'm interested in it. So ironically, here's the answer to your question. I'm still looking to buy in the superstar markets, knowing fully well that from a rent perspective in the short term, the superstar markets are the ones that are likely to underperform, right? Because of affordability issues. But then because the gap between the mortgage payment and the rent is so high there, because home prices went up, spectacularly. Even once they come down, that gap's still bigger than most other places. Eventually, when the market recovers and people have more money, it's the superstar markets that are likely to benefit more from rent growth in 2024 and 2025. So in 2023, just suck it up. And if I'm going to be buying a property in October, then I'm not really sucking it up for a long time, because I'm hopeful that by mid next year is where I start getting those benefits of these markets having a huge gap between mortgage payments and rent payments, and also demand picks up again post a recession if there is one.
Yeah. So demand wise for other multifamily investors right now, have you seen a lot of the industry turn in the sense of newer multifamily investors, syndicators, and is that something where, since you have pencils up now, you can capitalize on people that either just got a deal and it has, a fire in 4 out of the 15 units, and you can pick that up? Are those types of properties that you're looking at, or what type of properties are you looking at in those markets?
So while I'm pencils up and I'm underwriting properties again starting today, I'm actually more interested in my in my recapitalization fund. So I am convincing I have a regular value add fund, and I'm convincing my investors that we should turn the rest of the money that's in the fund that hasn't been used yet into a recap fund. So we are interested in recapitalizing properties that were purchased in the last 2 years that have severe problems. And these properties have multiple problems. One is, number one, they didn't buy a rate cap. Number two, they bought a rate cap, but now they have to escrow for a much higher rate cap in the future, because when they renew their rate cap a year from now, that rate cap's going to be $1 million or some completely insane number. And so now the bank is forcing them to escrow $50,000 a month into that escrow. Maybe they didn't even buy a rate cap. Maybe the rate cap was purchased, but it was so high that the property is bleeding $40,000, $50,000, despite the fact that there is a rate cap. So there's a lot of properties out there where I went to a conference and I recently asked this question. 500 people were in the room. I was standing on stage. So I said, how many of you have gone through a capital call? Not one hand was raised, which shocked me, by the way. But it sort of makes sense. I mean, this syndication industry sort of is very young. I've been through a capital call. I can tell you, I would much rather get a root canal than a capital call. And also, I know that 90+% of capital calls fail, right? They don't succeed. They fail simply because the investors think of it as, throwing more good money after bad. And you probably haven't put that punitive clause in that says, if you don't put money into the capital call, we will over dilute you. Like we will 2x or 3x or 4x dilute you. And most people haven't bothered putting that into their PPM. So you can only dilute them. And at that point, they don't care to be diluted. So a lot of people will beat you up during a capital call, but they won't give you the money, or they'll give you a smaller amount of money. Instead of you ask them for $30,000 and they give you $5,000. So I think most people don't understand that. Then there's syndicators who don't understand that once a property goes back to a bank, your career is effectively over. I'm not saying it's 100% over, but it's effectively over, because in this sort of environment, unless you choose to lie on your next loan, you have to tell them that you just send a property back to the bank. When you do that, the impact to that new property's loan is absolutely massive. The problem is, I have not seen a podcast, a panel at a conference, a set of people, a white paper about recapitalization, capital calls, and what happens when a bank takes a property back. I even talked to a syndicator last week at RaiseFest who was, the amount of Kool-Aid that this person was drinking was amazing, because he felt that, if the bank got his property back, and, the property, he bought it for 20 million, it's probably worth 18 right now. He felt that the bank, if they took it back, they would sell it for 18. And I had to educate him that no bank is ever going to do that. The bank is not going to go through a long, painful process of selling this property at value. And I asked him what the bank's loan is, and he said, the loan's about 13 million. And I said, your property is going to get sold for $14 million. It's going to get sold within days. The bank gets it back. Once the bank gets the property back, it's theirs. Their only obligation is to send you any money beyond their loan amount. That's their obligation. But they don't have an obligation to do a good job to sell the property at maximum value. In fact, they're most likely to call their favorite rich syndicator and say, can you show up tomorrow morning with a check, a cash check for $14 million? Right? And so investors lose all of their money when the property goes back to the bank. And most of these people don't know that yet. So I think what will happen is, as this information, obviously this information is going to get out. 4 or 5 properties went back to the bank in Q4. As it gets out, syndicators will learn. They're smart. They'll learn. Once they figure out that this is the most horrifying thing ever, they'll start looking at recapitalizing funds after their capital calls fail. And so there'll be a few funds in the industry that'll come in and recap properties. That'll put more equity into those properties.
Yeah, you make a good point. I don't know if I brought this up on the last podcast, but there's some syndicators. Well, first, before I go into that story, that syndicator that you were talking to, is that syndicator, has he been in the industry for 15 years or 3 years? What type of experience? 3. Okay. Yeah. So I think that just across, any type of industry, it's in flux right now. So a lot of the people think that, you know, it might be better than it is, and really still holding on to what they got into. There's one friend that I have that had some family get into a syndication. You know, he's not sleeping well at night anymore because that property that they bought in Texas had a fire in it, burned 75–80% of the property. And now the bank, how the debt is structured, won't provide them with, because it was structured poorly, any money to rehab it. So they're going to lose the deal and lose all the investor money.
I think those are one-off cases. I think those, when they happen, I think that it's very unfortunate that these kinds of things happen. Usually you don't lose 80% of a property during a fire. You tend to lose a portion of one building because, you know, multiple buildings. So I think that's very unfortunate. I really feel for him. But I think that the property, that's a one-off. You'll see 1 out of 1,000 or 1 out of 10,000. They don't really affect the marketplace when these things happen. What's going to affect the marketplace for sure if syndicators don't wake up and are not smart about it. They've got options. Luckily, they're not in 2011. They're not in 2010. They have more options. But I feel like that they don't actually understand their options fully. And so this will be a process of, can they understand their option, and can they weigh each of these options and figure out which ones are less painful? And whether some sort of contagion develops in multifamily in Q3, it's too early, by the way. Q1, Q2. I mean, people have money in reserves. They're still talking to the bank. They get some money from their own pocket. They put it in. They get some money from the top investors. They raise a little more equity. All of this stuff sort of gets them through another 6 months, 9 months. So I don't really expect to see a lot of these challenges happen until Q3, and then people will start to really think about, what are my options? And what I'm curious to see is, in the industry conference where I'm, speaking, or I'm on a panel, I think in the second half of the year, most people should be doing a section of their conference talking about recap, cash calls, renegotiation of loans. I think that's a critical service that is not being provided.
Yeah. I mean, and I think that and you could probably correct me if I'm wrong, but the market, sped up so quickly that, the people that do only have maybe 8 or 9 years, maybe have been myopic, and not really looking at other parameters. So they don't have that knack for looking around at other options. So now when they do need to look for other options, they're slow to the gate.
Yeah, and I think that they also don't understand how banks function. I think that the way that the banking system functions, if a bank loaned you $13 million on a $20 million asset, in their books, they consider that asset to be $20 million because that's what you paid for it, right? They consider that to be the value. And let's say the value of the asset falls by 10%. It's 18 million. The bank actually has a clause in the contract that says, hey, the property of your, the value of your property has fallen, so my loans basically got up in LTV. You need to bring in more equity. Now, I haven't yet seen banks do that, and it's actually fairly common for banks to ignore this, even though they're required by law to recapitalize or ask for a recapitalization when values fall. But a lot of banks don't do it, thank God. So I haven't seen a slew of those, but if a bunch of banks start, then other banks end up following. So that's another challenge where you may not be upside down. You may not be, cash. You may not be bleeding a lot. You think you can sort of get through it. And then you get a nasty call from the bank saying, we know what the value of your property is. It's gone down quite a bit. So I'm hoping that if values don't go down a lot, that doesn't happen, because obviously I could get that call just as easily as anyone else, and I don't want to get that call. But it's a possibility. You hit the nail on the head. People have 9 years of experience. There haven't been any foreclosures, recaps, or calls from the bank in the last 9 years. And right before that, there were thousands of such calls, but nobody's actually been in those meetings.
Yeah. I mean, when you get that call, how quickly do you need to get that capital? So, it's a 10% drop. How quickly do you need to get that capital call to the bank?
It's all a negotiation because the banks don't like those calls any more than you do. But some higher up in that particular bank, some senior executive said, "Hey, I want a analysis of all of my multifamily loans and risk. And if it's more than X percent, then you need to go back and talk to the people." And so, if I was teaching a class on that, I would basically say stretch it out, right? Stretch it out as much as you can. Don't jump on a call with the bank. Stretch it out. Take your time. Ask questions. Take time providing your data, because the more you stretch it out, the better for you, because you want the bank to already call in 2, 3, 4, 10 guys before you. And now it's like, I own all these properties. I'm a bank. I don't know how to manage them. And so they're more likely to, when you go back to them and say, "You're asking me for $1 million of equity. What I can do is, 550,000. If I do that, can you not ask me again at least for a year?" Now you bought yourself that year for the rest of the equity, and hopefully in a year the value of the property goes up because of inflation, because of rents, whatever it might be, close enough so the bank doesn't call you back, right? So it's one of those long drawn out games where you actually go back and forth and back and forth and back and forth, and very often your property is technically in default. They haven't taken it back, but it's technically in default, and you work to basically work with the bank to fix that default. So you have to have some cojones. You have to have balls to understand that don't panic when your property goes into a technical default. The bank really doesn't want your property back. They just want to work with you to cure a breach. But obviously, during that technical default, there are certain things that they might have given you that they won't give you otherwise, because they're holding those things over your head, like rehab money. And my advice for people is don't worry too much about rehabs right now. I mean, you're not going to get during a recession as much of a rent pop from a rehab unit as you would have gotten. So for the moment, I find that people that are still obsessed with holding on to their rehab schedule, my advice is, why are you doing that? It's not good for you. It's not good for your property. It's not good for your investors. Who's it good for? Your ego?
So you've speaking on that, you've loosened up your rehab time frame. So let's say you want to get 5 units of a 20 unit done within the next 3 months. You've pushed that to 6 to 9 months.
I have, because my message to my property managers is, I'm not at this point very driven by rent increases. I'm very driven by occupancy, right? So I want the property. You can't keep the property at 95% and rehab slowly. I want 97. So, either you give me 97 and slow down, or you go fast and give me 94 or 95. So my property managers know that there's something I'm asking for here. I want the property to be highly occupied.
Yeah. And that's going to help through obviously the tough times. So if I was a new investor getting in with someone that was coming to me, talking about pencils up and pencils down, if I was going to look for, to get into a syndication right now, what's the criteria today that I should be looking at, and the people I should be talking to?
I think experience is really key. In the past, syndicators didn't need a lot of experience. So I think experience today is not one check mark. Usually you do a check mark. This is really a 3 check mark for experience. The second is, is the syndicator able to put their own money into the properties if needed? Because I think that we are not luckily, we're not in a 2009 type situation, which sort of dragged on until the end of 2013. We're in a shorter situation where we need to figure out how to get our property through the next 12 to 15 months. And then I think we'll have options. We may be even able to raise more equity at the end of those 15 months, or simply dispose of the property at break even or close to break even, whatever it might be. And I think that those options may not exist today for certain properties. It's just not there. You just don't have the ability to do that. And so you have to get that property to that point. And so putting money in yourself, I think, is something that matters. Though I have to say that the people that are actually going to be investing in properties that are going to close in the 3rd quarter are pretty well off, because they got the benefit of the price declines. We've all seen the price of properties decline, 8 to 12%, some areas more than that. And so they're getting that benefit, but now they're getting very close to the point where the Fed will start cutting interest rates. So now that SOFR rate is going to fall over the next 18 months. I don't know whether it'll fall quickly or fall slowly, but we know it's going to fall because the Fed's equilibrium rate is about 2. They're at 4.5. So at some point, the Fed will try to return to the equilibrium rate. And depending on inflation, they might go, down slowly or go down faster. But they will go down and you'll get that benefit. So I think a lot of it is, even in Q1, if you're investing and someone's buying a property, I'm not really sure why you're investing into a property in Q1. Maybe you don't understand all of the stuff that I'm talking about and how debt is such a big deal. So all I would tell the investors is just be patient. You're still going to invest this year. But I think the second half of the year, you have a much better chance than in the first half of the year in terms of your property making money. And also fully understand the risk. I mean, there wasn't a risk 2 years ago, 3 years ago, of properties going back to the bank. Now it's pretty substantial.
Mm-hmm. Yeah. Conversations with banks that you have these days, are they pretty conservative on, well, I mean, I would assume they're very conservative, but what's the conversation on people looking for deals, utilizing the bank financing for deals and stuff like that? What's that conversation look like, especially with your business relationships with the banks?
I think the business relationships today are not meaning as much as they were before. The banks really at this point are obsessed with reserves. They're obsessed with rate caps. They're obsessed with LTVs, where before a relationship meant that you had the ability to get something better. Today, it doesn't matter much. I was doing an anecdotal, last year before any of this stuff happened. I signed on a new construction loan. It was a big property, 240 units. The loan was massive, and I was the primary guarantor. It was maybe a $50 million loan. And I remember the process of qualifying for that loan was about 2 days long, maybe 4 or 5 emails. Mm-hmm. And then recently we refinanced a 96% occupied 2022 built property where the bank was only giving us a 55% loan to value. And this is based on a recent appraisal. Obviously, this is a brand new property. It's gorgeous, blah, blah, blah. It took a month to get approved. It took a month. And this was a $22 million loan or $27 million loan compared to a $50 million construction loan. Yeah. So banks are not your friends at this point. They don't have any friends. If you were friends with them, you're not friends with them anymore. They're just focused on the financials of the deal at this point.
Yeah. Yeah. I mean, financials, making sure obviously they're going to cover their basis if stuff gets worse. And do you have any tips for people that are making sure that they're still talking to the banks on refinances if they're having issues with a bank? Have you had to go to a different bank, especially in hard times on 2009, 10, 11, 12, where this bank's not doing the refinance, so you go to another one? And how does that transition look?
We haven't started on that process yet because, as I said, we know how to drag this out. But I wouldn't be surprised if that happened for one of our properties, probably in the second half of the year or the first half of next year, depending upon how long this drags out. Plus, we're one of those syndicators that actually are putting personal cash into the properties to keep them, from having challenges. But if it happens, maybe I want to answer this question a slightly different way, because I think my scenario is a little unusual, right? I think we are here to talk about what the community should do. Mm-hmm. I think you should have a monthly meeting with every single general partner present and an underwriter present, and list all of your properties that you think have some level of risk. And every month update and say, these are our options. We can do this with this property. We can do this. We have option A, we have option B, we have option C. We can do option 1 and 2 on this property. By this time, if you don't get this, we're going to start a refinancing process. We're going to do this. I think everyone needs to be a little obsessed with that. And so I would take 50% of the time that you were spending on rehab and questioning your property manager on pet fees. Just get rid of that, half of that, and just focus on debt. That's it. That's your job right now, to protect investor equity, not to make them money. For the next 12 months, it absolutely is not your job to make your investors money. It's not your job. Don't try and do it. You only have one job. to protect their money, their principal for the next 12 months. That's your job. Stop doing any other job.
Yeah. I mean, I think, you know, people still are trying to say, okay, well, we can get, you know, X amount return, stuff like that. Like you said, this is more shelter in place and make sure that you can get through, you know, the next
1
12
year.
months.
1 year. Fundamentally, nothing has changed. I am not suggesting that these people that are talking about those returns are saying something wrong, because actually, we all know that as soon as the crisis started, construction, single-family construction in the U.S. plummeted. Multifamily didn't, which surprised me, by the way. But single-family construction plummeted. It's already down 32%. It's on its way down further. We're going to end up with 40, 50% declines for about a year and a half. So what's nice for us is those were homes that would have been built and people would have lived in them that are not going to get built for 2 years. So you obviously have a 500,000 home shortage that we are developing that I think we can monetize in 2025. That we can monetize in 2026, but you have to get from here to 2025, right? So I think 2023 is a tough year. 2024 is sort of a improving year, and 2025 is a let's monetize this. So I think our fundamentals haven't changed. I think our cap rates don't change in the long run. They've obviously decompressed. They will recompress at some point. I don't know when that point is. I'm guessing 2025. So they will recompress. So because fundamentally nothing changed for the business. Actually, what's changed is since 2020, nobody wants to buy an office anywhere in the US. So now all those office dudes, those billionaires, they're all around looking for multifamily, but right now they're just shutting up and not buying anything because it doesn't make any sense to buy it. These are very highly experienced companies. They understand debt better than syndicators. So they're like, we'll just wait for a year, right? Our chance will come. We'll be in a better market. So I think fundamentally what you're saying to investors is not wrong, and please don't think that I'm suggesting that, but that doesn't change the fact that the level of risk for properties has increased dramatically. And also you need these 12 months to figure out where rents are going to go in the future, because you know we're all guessing. I'm guessing. I just feel like my guesses are more based on data, because I'm gathering an obscenely large amount of data right now, probably 10 times what I usually do. And then also I'm looking at the previous crises, right? I'm looking at what happened in 2020 after COVID. I'm looking at what happened when the Fed increased interest rates 9 times in the 2015 to 18 cycle. How did that affect things? And then of course I'm looking at 2008, 2009. I'm also going back into the 70s because I don't have a way to measure impact of inflation. 74 to 82 was the last major inflation spike in the US. And so I have to kind of look at that and say, what happened to rents there? What happened to cap rates? What happened to values? And honestly, it wasn't that bad at all because rents stayed above inflation. In this case, I think that's not going to happen because rents went up. They were front loaded. They went up a lot in 2021. So now they may stay at inflation or slightly below inflation. But that's not necessarily bad news, because that still means that you get 3 or 4% rent increase in a recession, which you normally don't get, because you usually don't go into a recession with 5 or 6% inflation. You usually go into a recession with 0% inflation. And so you get -2, -3% rent growth. So the picture's not that bad. I just feel like people need to be more prepped for it and be spending more time on it.
Yeah. No, valid points. And I think that, what you just laid out there is good for people that are listening to really, look at for the next 12 months.
Well, the other thing is to at least be talking to 2 groups for recapitalization. You don't have to recap your property, but I can tell you, I'll say this, recap is 1,000 times more preferable than returning a property to a bank, right? But it's painful. It's painful for the GPs. It's painful for the LPs. But there are people that I know that I think, based on some initial conversations, they're 90 days from their property being repossessed. They're not talking with a recapitalization group. And I'm looking at those people saying, what the fuck is wrong with you?
Yeah. Neal, this has been good. I want to ask you, if I'm someone that doesn't invest in multifamily, but is in the real estate industry, or, I do, but I'm very new to it. What 2 things do you look and or watch for when the Feds come out and talk about interest rate hikes? For instance, today when they have a meeting and this week, what are the 2 things that you're looking at outside of the interest rate hikes or staying level?
That's very interesting. I think that I would look at single family home price trends because I say this, I'm a multifamily guy. I haven't bought a single family home in a decade, but multifamily is an adjunct of a larger single family market. If you look at how many multifamily units we built in a year, 300,000. How many single family units we built in a year? Over a million. So it's a larger market. It's a single family market that affects things. And I can tell you, apart from what the Fed is doing, the Fed will do what they're doing. The overall market is going to get affected by what's happening to the single family market. So far, I'm extraordinarily pleased with the single family market because it's held up, because people have so much equity that they're like, I'm not selling my property. I'm not selling at 10% less. And so what we've seen are prices have only really declined in these superstar markets like Austin, which were up like 75%. So they're down, 10% from that or 12% from that. That's fine. I mean, I think people in Austin are sickeningly rich compared to where they were 2 years ago. So I'm not crying any tears of blood for them, but I am not seeing any declines in markets that didn't see crazy increases. There's actual price increases today in Cincinnati, in Cleveland, and in Indianapolis. Like the heartland is doing well, and so I'm very encouraged by that. That people are not, feeling like they did in 2008, 2009. So if there's something that you should be watching, you should be watching that. You should be watching single family prices city by city to see where they're going. I do this through Flipboard. I thumb up every time somebody sends me how are home prices doing in XYZ city. I thumb it up, thumb. And eventually you're just getting every city in the US, right? And there's a lot of articles to go through, but I get the sense of what's happening in all of the big markets.
Yeah, I mean, I think the builders get it this time. They stopped pulling permits. They stopped, they saw kind of the writing on the wall. So that stopped. So that's one big thing because, if they, in 2008, they didn't stop building. They just kept, they kept the.
And it destroyed them, right? So I think they were much faster to react this time. They were much cleverer to react. They walked away from their deposits on all the land parcels. And so I didn't see Lennar stock, KB Home stock get hit as much. And by the way, their stock is back up. So keep in mind, they took action so much faster, having learned so much from 2009, that builder stock is actually up after going down. So I think I would also watch to see what the builders are doing, but my feedback there is it's double-edged. If you saw a 32% decline in new construction, you might think the sky is falling, but actually it isn't falling because new construction is detached from the market by at least 18 months. Those are units that are going to be built and delivered and occupied at least 15 months from now. So there's a lag there. So I don't necessarily watch it as much as I'm looking at home prices because that's affecting us now.
Yeah. The second thing I was going to mention too is it's just like you said, everybody has equity, and the inventory hasn't shot up like it did, 12, 14 years ago.
It's still early days. I want to warn everyone that real estate moves very slowly. It's still early days, but there's very encouraging signs on the inventory. It's continuing not to go up. It's sort of stabilized, which I think is great because if it does shoot up, then you see prices going down much faster. So lots of encouraging signs. The one other trend that I think is very useful to look at to truly understand is market by market, look at occupancy. Multifamily occupancy is key because if multifamily occupancy, which right now is right around 95, if it goes below 94, you're going to start seeing price cuts, right? So a lot of people will start cutting prices and then you start getting negative rent growth a few months later.
Okay. Good tips. Well, I appreciate it, Neal. I love having you on. You give a lot of information over the course of 45 minutes to an hour. So I appreciate you coming on and going through what you're looking at today in the next 12 months. And we'd love to have you on again later this year and recap kind of what the year looked like for you.
Yep, recap is the key word today. So for those that are looking to, have at least someone to talk about recap and understand how recap works, just look me up. I'm the only Neal Bawa on the World Wide Web.
Thank you so much.
Thanks so much. Bye-bye.